Hey traders, Igor here, MrTOPTICK.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing to this channel, liking this video, and sharing it with someone that you think could benefit from this. Today I want to talk about directional income butterflies. Obviously, butterflies are a very popular trade. They are a defined risk trade, which means that you know ahead of time how much is at risk, where you're going to make money, where you're going to lose money. So therefore, you can plan your trade accordingly, and that's one of the best ways to control and manage your risk. This is a trade that we put out back in October. This was October 27th. The ticker symbol was DPZ, Domino's Pizza. We're looking at a chart here. This is a daily chart, and this is not the charting software that I primarily use, but for our purposes here, I think this is going to do just fine. So the chart here, a couple of things that caught my attention here. We have price after moving down from about 420 down to about, we call it low 300s. This was a pretty strong downtrend. Started to form a bottom or a base. So I was looking for a potential trend reversal here. Two things I was looking at. Number one, MACD was already signaling bullish. The trend was not confirmed just yet since it was below zero line. But we have 8 and 21 exponential moving averages are about to cross bullish. We are below 50-day moving average here. We can look at something very similar going back to about April of this year. Right, we had a pretty strong downtrend, and then the underlying stopped going down. Right, so we're anticipating some sort of a breakout of a balance here. As you can see here, this is May 26th. We have 8 and 21 EMAs are starting to cross. We are below 50-day moving average, and MACD, even though it is below zero line, it is starting to come up, and I would assume that we could potentially expect a trend change, and MACD above zero line will confirm that. It worked out quite well. We have a very similar setup here. So what I did was I put out a note that I was going to set up a butterfly looking for a directional move. Stock was trading at the time at around 335 or so. I went out to 16th of December, which is 50 days out. I chose my short strike at 370. This was my target. And I set up this butterfly in a way where I did not have any upside risk in the event that the trend was going to be pretty strong towards the 400 or higher. So I chose a 30-point wide call debit spread, partially financed by a 20-point wide call credit spread. This trade was going for a net debit of $7.40. I know that $740 per one butterfly is my absolute max risk, so I can size this trade based on that number. I don't have any upside risk, meaning that if the underlying shoots up over 400 and it expires above 400, I cannot lose in this trade. What I'm going to make in that case, if the underlying is above 390 at expiration, I have a 30-point wide spread and a 20-point wide spread. So the difference between the two is 10 points. That's $1,000 minus $740 that I paid for it. So my max potential reward on the upside is about $260. So this trade was put on for a debit of $740. I had an implied probability of profit at around 36%. Now I'm going to go forward to following adjustments. There were only 2 adjustments, and this is what I want to focus on. Couple of very simple adjustments that could potentially remove all of your risk, leaving you with room for more potential reward. And at the same time, if the trade does not work out and the underlying goes against you, you don't have to worry about getting out of the trade, stopping yourself out, or having to look at the trade every single day wondering what to do next. Now we go forward to the next adjustment, which was on November 2nd. Here we are, 6 days in the trade. The underlying is at the 341. It's headed in the right direction, and my number one goal, as always, is to pull out as much risk out of any trade as possible, give myself room for more potential upside, preserve capital, because I can always redeploy capital if I see that I have a trade that's working and I'm not long enough, if you will. So I could always add deltas to any trade. So in this case, what I decided to do, I decided to roll my long 340 call up to 350 strike, selling the 340, buying at 350. This was a credit adjustment, meaning I collected a credit for moving my 340 up to 350. Credit was $5.30. If I collect $5.30, my original outlay was $7.40. Now collecting $5.30, that takes my risk down from $7.40 down to $2.10. Right, so this is what this trade looked like after I made my adjustment. Now I have a balanced butterfly, right? So I got an opportunity to take some risk out of my trade, but what this adjustment did, it introduced upside risk. Remember before, what I did not have to worry that the underlying was going to run over 400 level at expiration and I wasn't going to lose any money. Now, by rolling my 340 call up 10 points, I have introduced that upside risk. Now I have a 20-point wide debit spread and a 20-point wide credit spread. We have 44 days until expiration, and now we go forward to the following adjustment, which was 8 days later. Now here we are. This is 14 days since I took the trade, and it's about 8 days after I made my initial adjustment. This position is looking really, really strong. I'm up about 30% or so on risk. The underlying is sitting right at 347. You know, looking back at the chart, it's kind of headed in the right direction. We're running into some potential trouble. We came down to test the 21 EMA. Now 8 and 21 EMA are still bullish, which doesn't really make me too concerned. However, I still have risk now, not only on the downside, but also on the upside. My next adjustment is to take out as much or all risk, if possible, out of this trade. This adjustment is also what's known as reverse Harvey. For those that are not familiar, you can Google the term. There's a ton of information out there. Basically, what I am doing, since I have two 20-point wide spreads here, I'm going to roll the wings closer towards the body of my butterfly. So I'm going to roll my long 390 down 10 points, and I'm going to roll my long 350 up 10 points, which will put me in a similar balanced butterfly, but my tent is going to be much smaller. That's the negative, but the positive is I'm going to collect another credit, which will go towards offsetting my risk. My risk currently is 210. If I make the adjustment, and this is what it looks like, I rolled the wings. Now my tent is very skinny, but the adjustment that I just did, I collected another $3.55, which means if my risk before was $2.10, collecting $3.55, I don't have any more risk in this trade. As a matter of fact, I have a net credit of $1.45 to keep this trade on. I have 36 days to go. I don't have a lot of concern for this trade because, one, I don't have any more risk in this trade, and two, if I pin 370 at expiration, this butterfly is going to pay really well. So I left it alone for the next 30 days. We can look at what this trade looks like today. We have 2 days until expiration. Okay, we're sitting right at 364. I haven't changed a thing about this trade, right? I'm in 360, 370, 380 call butterfly. These are two 10-point wide spreads. I'm in it for a net credit of $1.45, which means that if the underlying is below 360 at expiration, I'll make $145. If the underlying is above 380 at expiration, I'll make $145. If the underlying is at 370, I'm going to make 10 points or $1,000 plus $145. So this trade has a max potential reward of $1,145 at expiration. So worst case, if it goes down, I lose nothing. If it shoots up, I lose nothing. Now, the next 2 days, we'll kind of sit on it, see where it goes, and I'll try to get out of this trade probably in 2 hours before expiration this week on Friday. I hope you enjoyed this video. I hope you learned something new. If you did, please like this video, subscribe to the channel, and until next time, take care of the risk. The profits will take care of themselves.